Welcome to Inside Asia, a podcast by SEB where we try to make sense and connect the dots of what's going on in Asian economies and financial markets and their impact on investors and Northern European companies with exposure to Asia. My name is Sean Yokota. I am head of markets in Asia for SEB. And with me, as usual, is Fredrik Hähnel, head of Asia for SEB and general manager of SEB's Singapore branch. Hi, Fredrik.
Hi, Sean. Good to be back.
Thanks for being back. Today, we have also invited Eugenia Victorino, who is our head of Asia strategy and research. Welcome back to the podcast, Eugenia.
Thank you, Sean. Nice to be back.
Okay, Frederick and Eugenia were both in China last week, and in this podcast, we'll go over what they learned on the trip and whether it has changed their views on China going forward. So let's get started by asking your initial impressions from the trip.
I think the impressions were mixed. We're all, hoping for this strong recovery in the Chinese economy. Uh, if anything, I was a little bit maybe surprised on the downside there. Although it's very, very mixed. I mean, you look around and you see that uh, hotels in general are quite full. There's a lot of activity. Restaurants, when you go out to eat, are not really that full. So you see some signs that people don't really have the confidence yet to go out and spend. And Eugenia, I'm sure, is going to get back to that later and talk about how domestic travel may be back, but foreign travel is definitely not back. I saw a few anecdotal things like property projects that we have read so much about, and I'm a little bit surprised that I saw actually on the way from our office to the airport in Shanghai, for example, a number of property projects of apartment blocks that are kind of almost finished, but were at a complete standstill. I don't know if that's what kind of sign that is. I was a little bit unexpected to see that in Shanghai. We all know, and again, that's something I'm sure you will talk about, Eugenia, but we know the property sector is particularly important for China's growth, not least through its wealth effects. After all, the Chinese property sector is the biggest asset in the world, and a lot of Chinese money is flowed into that sector in terms of savings, etc. So I think my take is that I have a little bit question marks around that. I also think that the consumer confidence is quite a lot impacted by the shocks after the COVID lockdown. They had a very good initial success at the beginning of this in 2020 when China actually had its open up. I mean, we all expect to see these open up effects in China, but actually China did open up in 2020, not the its borders, but inside China in this bubble. China basically didn't have COVID in 2020, or it was very, very effective in sort of uh, killing it wherever they saw it. And so we saw a very, very strong boom then, and I don't really think that we see that at this point. So there were kind of some signs of that. When it comes to our clients, we can come back to talk more about that, the different, what the companies said, but it's a very mixed picture depending on what industry you are in. And I think we are both, Eugene and I, like many other visitors, probably taken aback by the strong development and fast development in the EV, in the electric vehicle sector, which is very real in China. We met with a number of automotive companies who all said basically that the foreign companies were quite shocked when they visited the Shanghai Auto Show. I think it was in April this year, and saw how fast Chinese auto companies have gone ahead with developing new EVs and luxury brands, and companies like BYD, XPeng, Chery, and Geely, etc., are now extremely far ahead in launching electric cars on the world market. That has both very positive implications for companies that are well positioned for this, but is also a big challenge for other companies. But we may get back to that. So I'll leave it over to you, Eugene, if you want to take over from here.
I really think that the recovery is still ongoing. The problem was market expectations ran well ahead of itself. So that's the problem. It's disappointing expectations. It's not that it's contracting. There is clearly a lot of improvement from last year, but keep in mind, last year was a real disaster. So, from a year on year perspective, it should be better. That doesn't mean it's strong. So those are just my initial top line takeaways from that trip.
Thanks, Eugenia. And just from my point of view, just to add on to some markets, things developing for China, I mean, you clearly see there's an underperformance in Chinese equity markets, where the U.S. S&P is up 10% this year almost. If you look at like Korea or Taiwan, they're up about 15%, whereas China is relatively lower. Their Shanghai Composites may be up 4%. And then look at the currency. Even today, it's weakening quite a bit, and it's moved past 710 versus the dollar. And you can see the Chinese authorities are getting nervous about how fast it's starting to depreciate and lose value. So you do see this relative weakness coming through. Maybe we'll just start with the economics. I know you guys have mentioned some things about property and consumer, but Eugenia, maybe you can just give us your thought on what you think is the short term and the long term on China economics based on your trip.
So I think the real problem here is that confidence in general is still weak, but data would suggest that it is continuing to improve, but it had dropped so much last year that there is a lot of ground to make up for. However, I think it's not fair to expect that the recovery and confidence should come overnight, or at least in the first 4 months. Because really, we are just only on the fourth month of reopening. If you look at the recovery of other Asian economies that did not have income transfers to their households, their recovery in consumer confidence and even in their purchases continue even more than 12 months after their actual reopening. So I think the expectation that it would be blockbuster within the first half of the year is just unreasonable. Having said that, it is also very interesting to note that private owned Chinese enterprises are now more pessimistic than the multinationals. So that is once again going back to confidence. When we ask them what was the basis of that uncertainty or caution, it kept coming back that they were very concerned by Beijing's focus on national security, such that they are not so sure that the policy support, or the policy focus would be on growth, because now national security seems to be trumping the priority on growth.
Okay, so it looks like Eugenia, the confidence both from domestic business consumers are a bit weak. I mean, is that also translating to the property sector and what Frederick saw on his way to the airport with not much activity going on?
Indeed. So actually, even the numbers would already suggest that the property prices have already bottomed out. But keep in mind that for the third tier cities, they were contracting on month basis for more than 18 months. So on a year basis, it's still negative. However, I think it's very important to note that the entire country did not have a property crisis, because the first tier cities like Shanghai and Beijing, they never really saw their property prices go down. Meanwhile, the recovery in the property sector is already spreading to the second tier cities, but the third tier cities are definitely struggling. On the other side of the coin is that households are now buying houses once again. The difference is they're only willing to buy ready made units. And for China, that's a very different consumption pattern of the property. Previously, most of the property purchases were done in the pre-build area, pre-build sector. So what is happening is that the property developers still cannot sell a lot of units in the pre-build market. So the incentive here is for the property developers to focus on the outstanding projects, which would then translate to very weak construction activity. Because as long as you do not have new starts of projects, your overall construction activity would still be below trend.
So we aren't getting the usually, when something slows down, the government pumps a lot of money, gives out a lot of loans, get the property sector going, and then help out the consumers as well. But I guess this time they're holding back. That's why none of this is moving forward.
Indeed, so actually, our forecast for 2023 is for GDP to rise by 5.9%. After that trip, I would still say that 5.9% is possible. However, I do not really expect the government to release a bazooka kind of policy support because even if they underperform my expectations of 5.9, even if they reach 5.5%, it's well above the target. So the issue here is not the ability of the government to pump up support. The question is whether there is willingness or an appetite from Beijing to release that support. Last month, the market was expecting cuts in the interest rates. They did not deliver. There was also expectations that infrastructure spending would improve. They did not deliver. So at this point, it seems that Beijing is willing to let the recovery of consumption to take on the the role of a star for the 2023 growth story.
Aren't they worried that you see like unemployment rate for people that are young, they're up to 20% now. Won't these people get upset and cause some instability?
So there are two sides of the story there. First of all, the unemployment rate of the youth in China is really high. And that's nothing special for China. Even for most countries, the unemployment rate for the youth is quite high simply because new university graduates do not necessarily take on the first job that they are offered because it takes time before the young people would actually find their place in the labor market. So the natural unemployment rate for the youth in China was estimated to be around 13%. But the latest number is 20%. So there is clearly a mismatch in the skills of the new graduates. So, from that point of view, it is also the issue of the private sector. A lot of the employment generated previously was due to the private sectors or the Chinese owned private entities. And as I said a while ago, the sentiment of the private owned Chinese entities is actually negative. So that would actually lead to some delay in the hiring. The expectation is that the labor market would continue to improve from here. And actually, overall, the labor market has already improved. So, if you look at the overall unemployment rate for for all the cities or even in the top 31 cities, that has already improved substantially, whereas the unemployment rate of the youth just kept on deteriorating. So, in my view, there is room to improve here, but you cannot underestimate the structural issues that would hamper the ability of the young to find new jobs.
Yeah, and I can add there that I think one of the conclusions that I drew when I was in China this time is that in the Chinese economic model that has been you know the model that's stuck to ever since the opening up late 70s has been an export and investment driven economy where consumption hasn't really been a strong driver. And China was in the beginning the factory of the world and wasn't really that innovative. But since a number of years, if you go back to 2015 when China first um, launched this plan that they had, this called China Made in China 2025, where China wants to become a world leader in a number of in 10 specified technological areas. I think China has been very much aware of the need to reform its economy and change it from this investment and export driven economy to a consumption driven economy that is very innovative and where China is also self reliant in technology as they see this geopolitical landscape change. And I think a lot of that was already in the making before COVID broke out. I think during the COVID years, China had to go back to a certain extent to the old model, and it was like if you think back of late 2020, China's export growth at that time was between 30 and 35%. So China really gained a lot from this in the beginning when the world uh, consumed a lot of goods. China's supply chains were up and well functioning when a lot of other countries were locked down. And China also invested a lot and stimulated quite a lot in infrastructure, etc. during COVID. So that shift didn't really happen then, and I think there's a certain willingness from the Chinese leadership now to allow for that shift to happen. So, as long as things don't get out of hand, i.e., you see broad falls in property prices, or you see, unemployment rates going up very quickly, or the economy cooling down too quickly, I think there seems to be a certain patience from the leaders to now also try to see this shift, and you can really feel it. I mentioned it in the beginning, this shift in the automotive industry, for example. I mean, when you land in Shanghai today, one of the things that you realize once you step out in the streets is that, oh, it's much more quiet than it used to be, a few years ago. Simply, all the revving and honking that you're used to is not really there anymore. And one reason is, of course, that there's nowhere in the world where more electric cars are sold than in China at the moment, and 20% of all cars this year are electric cars. And when we talk to the automotive companies, they see that already next year, roughly 40% of all cars in China will be EVs, and that will just continue to grow. One such, again, anecdotal experience was when I was on the flight from Shanghai from Beijing to Shanghai, and one of my oldest friends in China, who runs his own firm, was on the same plane. He said, "Why don't you come with me? And I'll drive you to the hotel when we land in Shanghai." So I stepped into this fantastic car. It was absolutely mind blowing, really big SUV, very very high tech, with lots of lights, and a huge uh, map in the middle, so digital map in the middle of the car. Fantastic leather seats that could give you a nice little massage in your back, and I was like, what a great, fantastic car! What car brand is this? Ah, it's a Zeekr. It's a Geely's brand that's now very successful and innovative within EV cars. And I see that that's just a sort of an eye-opening experience how fast China is moving in this. And if you look, to China's economy today, China is a world leader. Is becoming a world leader in this area, but it's also becoming a world leader in environmental technology in general. I think we talked about this before, how incredibly dependent, for example, Europe is on China supplying it with solar panels. China is now the absolute world leader. It produces somewhere between 80-90% of all solar panels in the world. It's a world leader in batteries, etc. And even in wind farms, China is very successful. So it's fantastic to see how China has really, I mean, for all its faults and all the things you can see as challenges in China today with the property sector, and the indebtedness, etc., it's also extremely well positioned in this shift that's happening in the world now. China just recently, I think it was last week, for the first time, its new airplane, Comac, launched its first commercial flight in China. So now China has the only company that is actually now competing with Airbus and Boeing, and that's absolutely mind blowing. Just imagine China is now launching the third airplane company in the world, and it's so strong and so well positioned to the entire emerging markets like Africa, South America, Central Asia, the Middle East, etc. And we all talk a lot about artificial intelligence at the moment, right? With Chat GPT being kind of the topic in all media for the time being. But one should not forget that, of course, the US is extremely successful now in artificial intelligence, but so is China. So AI is one of these areas where China already in 2015 launched a plan that it wants to be world leading, and China wants to be a world leader in AI by 2030. It also has its own equivalents of ChatGPT that have been, also launched and discussed in China at the moment. So I think it's a lot of that happening at the same time, which I just want to share that view, because when we came back from China, you have a very mixed view. Certain things are not going to be the same anymore, and certain parts of the manufacturing industry has seen its best years. It's not going to come back probably, but there are other areas where China will be extremely successful probably going forward.
It's funny, Frederick, that we visited Comac together over 5 years ago, and we saw these slogans of that there's a long-term commitment that's needed in struggle to succeed. And I guess that's what you're starting to see is these structural long-term plans or finally coming on board and helping. When the property sector isn't doing that well, export isn't doing well, these long-term seeds that's been planted are starting to help out. So maybe you're much more optimistic longer term.
Yeah, no, exactly, but I agree with you. It is extremely interesting, and I think that goes back to a question that we've been discussing for many years. All of us who are analyzing China or doing business in China said, how successful can a country with that kind of political system be? We would like to believe that that kind of system wouldn't be as innovative and forward looking and able to pick up on trends as the most dynamic maybe economy in the world, the US. But it's becoming more and more difficult to draw that conclusion, right? Because China is extremely successful in these areas, and I think that's also part of the reason why they're so challenged by the US, and the US now wants to limit certain access to technology for China. That's really one of the most important topics related to China at the moment, I think.
I think it's very clear how China was able to pursue that industrial policy even during COVID. And you already mentioned that the electrification drive came really fast. And I think what is very important here is that while Europe was on lockdown and dealing with the energy crisis last year, the R&D of the Chinese EV makers continued unabated for 3 years, which actually allowed them to really widen their gap. There was already a technological gap. And just to clarify, this is the Chinese EV makers are much more high tech than the other um, auto manufacturers in the world. But after after a number of stops and starts in the last 3 years for the rest of the world, while the EV makers in China just continued, then they just shocked the world at the auto show in Shanghai in April, and they came out with very fantastic cars. Apparently, these days, it's not enough to be touch screen. Some of them are even offering motion sensors wherein you don't even need to touch the screen to turn on the aircon or even to increase the volume of the music.
Yeah, and China is also, we can add, very close to launching driverless cars, for example. BYD is very far ahead with its research. So that's also an interesting example of this, of course.
Is there anything more you want to add about the auto industry? Because I know you guys kick the tires in that part of the industry.
No, no, I think we can just say that the clients that we met in China that are again positioned for this, and that goes for sub suppliers to the automotive industry. It goes to the chemical industry that partly is also exposed to the automotive industry. Those companies that are exposed to this particular segment, the luxury brands and the EV sector are very positive on the prospect in China now and are investing quite a lot at the moment. But again, companies that are exposed to the construction sector, construction equipment, etc., and other parts of the economy where you don't see this growth anymore are considerably less positive and are still committed to China and staying, but are also maybe not investing as much. And that's also, by the way, a very important discussion point now among companies in China is, considering the geopolitical situation, how do you diversify now? And that there, you can clearly see that companies that see a very strong market going forward. And one should not forget that for many companies, China is the biggest market in the world or the second biggest market in the world. And in the chemical industry, for example, I saw that BASF recently publicly said that they expect in the next 5 years or so, 40 to 60% of global growth in their sector will come from China alone. So these kind of companies, they're very very bullish. But companies that are sourcing to a very large extent in China are continuously now gradually diversifying away from China, and companies that have R&D activities, some are actually increasing their R&D activities in China in order to be close to where the latest innovations are taking while others are reducing their R&D in China in order to protect their patents, etc.
And I guess with the auto industry, like you mentioned, there are auto parts, so the entire supply chain needs to build up. And I guess because of these tensions with the U.S. or tariffs that happen, I guess the companies have to be fully, the entire supply chain has to be fully built in China, right? So I guess it's not just the auto industry that's going to do well; it's everything else that's tied to it.
You're absolutely right. I think it's good you bring that up. The whole the China for China discussion, that you're manufacturing in China for the Chinese market, that's very real. You really hear that repeatedly in meetings with companies. Definitely, the China plus one strategy that we all always talk about, that you diversify a little bit outside of China. I didn't see that very strongly among our clients. They're investing in other countries where they see a good market primarily, but I don't see that really concretely in sort of part of the diversification strategy.
That's very interesting because actually, when I had spoken to other stakeholders in Beijing who were also meeting with private owned Chinese companies, it seems that the Chinese companies are really pursuing their outbound investments into the rest of Asia. So, so there is a difference in the strategy. It would seem that the Northern European companies are are definitely focused on China if they're already big enough. That needs to be clarified because if they're big enough and they are localized enough, then they're likely to do well. But those that are small, they're definitely being hampered by increased costs on regulatory compliance. There's also a lot of there's also a lot of reputational risk these days when they have to talk to their own stakeholders in Europe. So you have to be very smart these days. It was very interesting when one of our meetings said that previously you can make money in China even if you're not a good businessman. These days, you have to be good to be able to deliver the money because previously you can deliver to the headquarters around 20% growth and they would be happy when actually, personally, you'd know that you should have been able to deliver 40%. That's because you are not a good businessman. These days, you can still deliver very good growth, but you just need to be much better at it.
And a question for you guys, I guess related to that, you are hearing this recalculation and risk reward doing business in China, where because growth is slowing and then these risks that you mentioned, Eugenia, are also growing, then it does change the calculation of whether to stay in China or what to expect from your business in China. Is that right?
Yes, so actually these days the risk premium is much higher. So although there is a clear macro story of a recovery in China, but these days the investors, both corporate and financial institutions, are just asking for a much higher growth outlook for them to put the money on the table.
Do you guys want to also talk about the green space? I heard something about wind before that's picking up.
So clearly, there is a continued investment in the green transition, green energy transition within China. But there was also some backtracking in 2022 because we can see clearly from the data that they are also now producing more coal powered energy. Um, that doesn't mean that the investments are not coming in. However, one interesting conversation that I had was that yes, there is an increased investment in capacity. The problem is the distribution or the connectivity of that green energy to the rest of the grid. So there seems to be a disconnect because typically, once again, when you're talking about China, you have to talk about the incentives to the local governments. So these days, the incentive to produce or to expand the capacity of the energy or to diversify the sources of energy is clearly owned by the local governments. However, the central distribution or like the distribution to the rest of the country is not owned by the local government, and there is no incentive for these local governments to invest in that distribution network because that's no longer within their jurisdictions. So There are instances wherein you can see a lot of investment in solar or in wind or in hydro, and then it stops there, and then the next province will have to deal with their own energy plan. So at this point, this is very classic China that typically happens. Sometimes you have issues with coordination, but then you also have the other side of the story wherein there's too much centralization. So it's very difficult to find the balance in China. But yeah, in this picture, there are investments, but there are also some less green energy going on.
Yeah, and I think for China, this is also a security issue, right? That China had its own energy crisis not so long ago, and I think part of that was that they're making this transition from coal to renewable energies, right? So China is definitely increasing also the capacity for energy produced by coal and imports of coal, etc. But I think that is more from a security perspective. I think the overall plan is definitely to reduce emissions in China, but also continue to be world leading in these technologies that China can export to other countries.
Yeah, so if you think about the priorities of going to ESG or green, there's one that you mentioned of national security concerns to be energy independent, and then the second is to actually become green for the environment, and then third is for business to get market share and build the technology. So how would you rank those three in terms of China's priorities?
I would think their priority is to go green, but not at the expense of energy security. So they continue to invest as much as they had promised, but they will not necessarily haphazardly cut the coal production the way they did in 2020 and then face shortages. So I think they learned their lesson in 2020. So it is likely that the long term share of renewable energies would continue to rise. But coal will always be part of the mix because at the end of the day, China is actually self sufficient in coal. And if worst comes to worst, coal can always come and save the day.
Frederick, Eugenia picked number one as security. Do you agree with that one?
I think security comes as number one for China. There is no room for compromise there. But once that's secured, which it will be, um, I think that the driving force for China as number two is not to be a good global citizen, which may be kind of the purpose of certain other countries, but rather that China has to deal with its environmental problem for its own sake. Having lived in Shanghai at the peak of emissions, I can tell you it was very difficult to live there at the time. And I think number three, if you can make some good business of this and this can contribute to the transformation of the country, I think China would miss such a great opportunity.
Yeah, I guess like even 10 years ago, the pollution was a major issue. And that was a big, became a bit of a political issue as well. So I guess the authorities kind of picked that up and they have moved on. Why don't we move on to any other anecdotes or funny things that you guys saw or heard on your trip over there?
I think that one thing that we can share, Eugenia, was when we asked our colleagues. It was quite interesting, right? We asked, it's not a funny fact, but an indication. We asked how many of our colleagues had traveled abroad so far after China opened its borders, and it was only one colleague that had traveled uh, for vacation. And when we followed up and asked how many of you are planning to travel abroad this year, no one raised their hand. I'm sure there are those who will, but it was just an interesting thing. I think if you would ask the same question in Europe, the majority would probably raise their hands. So that was an interesting little anecdote as well, Eugenia.
Indeed. So actually, when I asked them why they were not planning, the first thing they said was the cost of the airline tickets. To be fair, it really is horrendously high. But the second one is they're saying that the visas are actually much more complicated to obtain. And then there are unverified reports that there is now a 70% rejection rate for Schengen visa applications. But then I'm thinking, if it's taking you too long to get the visa, but you're still going to get the visa, why don't you start planning now for a trip in October? They could not really answer that. But I think what is interesting also was when I went to the Beijing airport on the way back to Singapore. And in Beijing airport, it's very interesting because you enter the same entrance, and then on one side of the airport you have the domestic flights, and on the other side you have the international flights. And right before you go through the security, you can see that the airport is quite busy. So I was under the assumption that yes, we are really in the recovery. And on the way to the immigration, um, I could still see on that part of the airport that all the stores in the domestic part were open. Like you can see all those luxury brands from Europe, they were open and they had a lot of people going around them. But to my surprise, the moment I passed through the immigration, there were only two stores that were open, the liquor store and Hermes. Everything else was closed. So if you were planning to eat something before the flight, or you thought you could just skip your meal and go and eat at the airport, I'm sorry, you will have to go hungry unless you're able to find some bendo machines that had food. Because clearly the flights are not there. And it's also very interesting that when you actually have to go to the gate, you will pass through so many gates that had no flights in them. So the 20%, 30% from pre pandemic level, that's not just data, that's the reality.
Yeah, and I think that you know, I think the conclusion is that people are a little bit more careful still. I think the shock from the very strict zero COVID policy, that was a success to start with. Like I said before, in 2020 it was perceived as China's policy and strategy really worked. I think that became a total disaster last year. There's no other way to put it. With cities being locked down for several months, and people having to stay in their homes and couldn't move freely, etc. So I think it was a shock. China is still a little bit shocked from that. I think the scars are still there. So I think to conclude, I mean, this will take a little bit longer than we expected for confidence to come back. And another anecdote on this travel thing was, on Chinese TV, there were a lot of programs now saying that it's dangerous in certain very classic Chinese tourist destination like Southeast Asia, that there's been a lot of crimes and Chinese tourists have been attacked, etc. So I think there's also seems to be from the authorities, with everything that Eugenia also talked about with passports, etc. They probably want this to go in phases after such an extreme situation for the past 3 years. So I think it takes a little bit longer. The Chinese tourists abroad will probably also take longer than people have expected. But there are also a lot of positive underlying currents in the Chinese economy, and it'll be very interesting to see how that plays out.
And then we'll just go to the final topic that which always covers is that what are the implications for clients, whether that be corporates or financial investors.
Definitely for our clients, this is very high up on board levels discussion on China, and diversification of risks, etc. And like I said before, I think for many industries it will still be a very strong economy, and they will continue to invest, and they should continue to invest for the market. There will be others that will not see the same market. That's very obvious. It's not going to be all boats rising anymore in China. That's very obvious. Certain industries will be beneficial going forward. Certain divisions within each company will be very bullish on China, while others will be less so. I think competition is definitely on the rise, so a good competitor analysis will be necessary, an updated one, because it's changing so fast in China. And I think looking through your supply chains and where and how you do your R&D will also be very important when you plan your strategy and your goals in China going forward.
So I think it's different for different stakeholders. For corporates, definitely the bigger companies that are already big in China and more importantly, that are already localized in China, they would still prosper, in my view. But the smaller ones, it's just becoming more and more difficult to enter China if you're only entering now. So perhaps the other Asian economies are much more cost efficient for that strategy. But the big ones and the localized ones, there is a definite market for that. However, I think what is happening is that when these big companies become more localized, they would essentially become a Chinese company with foreign owners. From that point of view, the competition will be not against other foreign owned Chinese companies. They will come face to face with Chinese owned Chinese companies. So that makes it a little bit harder, which would just mean that you need to be a lot more smarter to do well. Now, foreign investors, on the other hand, as I said a while ago, the risk premium is so much higher, not only because of the reputational risk, but also the geopolitical tensions. The geopolitical tensions are not just on the Ukraine Russia war, but the geopolitical tensions in Asia are actually closer to home, and that's called the South China Sea. So that also has an impact. So in this environment, it's very difficult to do an investment decision on the macro story on China, but probably pick your industry story and then you can still have winners there.
Very good. With you guys, we can go on forever, but in the interest of time, we'll try to wrap it up. Let me just kind of mention the top three takeaways that I heard from you guys. One is on the kind of the economic outlook. It is maybe still a bit weak because of this confidence domestically, whether it's households or corporates. It's still a bit low, and then it could take a little bit longer for the recovery to kick in than what we were expecting. Second thing is that this industry specific um, excelling. So it's not the entire country doing well, but you got to be very specific on which industries that do well, such as the electric vehicle areas. And then lastly, I think this is just an ongoing theme, is that, as you said, Frederick, your outlook is a bit mixed because in China's case, maybe the current outlook may not be that positive, but you can never roll it out because of its size and it has long-term plans that's kind of surprises things that we don't expect. So we should always kind of be on lookout and not get too negative just because of what's happening short term. With that, thank you, Eugenia, for coming back onto this podcast, and I hope you'll be back soon.
Thank you so much, Sean. Thank you, Frederick.
And Frederick, as usual, thanks for co hosting this podcast.
Thank you too, Sean.
And finally, thanks everyone for listening, and have a great day.